G'day, Fred. How are you?
You good, Rich, yourself?
Yeah, not too bad. Unfortunately, Darren can't be with us tonight. He's away on a holiday, I believe, for a few days. And so it's you and me together, mate.
Good out. Let's do it.
All right. So, look, just to refresh everyone's memories, over the last few podcasts, we've been working on the Donchian Breakout System. And we've been undertaking a large number of walkthroughs of how that system has navigated different markets. And so in our last podcast, we applied this Donchian Breakout System to Bitcoin, and we got some marvelous results. But just reflecting the fact that this particular nature of breakout system works very well in high volatility regimes. Fred, anything you want to add in relation to overall the nature of the Donchian breakout?
I think it's been proven to be a good trend following system. It's picking up the longer term trends. As you say, Bitcoin's thrown a bit of a spanner in the works because it's such an overpowering instrument that it does put out some challenges when you come to your portfolio creation, but you'll see that as we move forward.
Yeah, exactly. All right, so look, what we're fairly confident now in the robust nature of the system itself, having tested it across a large number of different markets across asset classes. So now we're at the stage where we want to compile the results into a portfolio. And what we haven't addressed to date is the impact of correlation and how that affects the overall portfolio performance. So in this particular podcast, we want to show you a visual method that we use that addresses correlation and how we can improve overall portfolio performance by removing those particular markets that possess adverse characteristics when markets are unfavourable and the portfolio is entering drawdown periods. So we'll get straight into it, and I'll show you how we do this visual process. So we now have a spreadsheet which has recorded all of the individual results of the runs of the different markets that we have tested. And in this case, we've got around a portfolio of 22 particular markets that we are happy with including in our initial portfolio. And when I come to this particular worksheet here, we see the overall results of the 22 solutions being expressed as a consolidated portfolio, where the blue line here represents the floating equity of the portfolio and the grey line represents the realised balance of the portfolio. And in this section here, which is a drawdown, we see the drawdown signature over the course of the time period that we have tested these markets on. Now, some of the particular markets, we had long range data going all the way back to 1996, for instance. Other instruments, we had shorter range data. But that's the nature of what we're working with. Over the course of time, as we add new instruments into the portfolio, we find that we get the impacts of new instruments impacting on the portfolio during different time intervals. And we'll see that as we step through.
The other thing that I just wanted to point out was the equity curve there. The blue line, the unrealised equity, the floating equity, is hovering above the realised balance throughout the whole exercise. In other words, we're constantly having a positive floating equity in relation to the closed trades, which I think is a fantastic outcome in itself.
Yes, what that clearly demonstrates is we're not warehousing risk. So if we were warehousing risk, that floating equity would be sitting below at periods of time, below the realised equity. You see that often with techniques such as martingale techniques or grid trading techniques or mean reverting techniques, where there are times where you can be in a very adverse position in terms of your overall equity, which is not being displayed because you're only seeing the realised balance. But by sitting above the realised balance, we are confident that this is the worst case scenario we're going to receive, is this realised balance line. So as we step through, so this particular master portfolio comprising 22 particular instruments, over on the right hand side, as I scroll through, you can see the individual markets that we've actually tested. And as I step through, we'll have a look. So the first market, AUD USD, you can see that its individual floating equity curve is highly volatile. It's certainly not a straight linear line of ascent, and this is the nature of trend following systems. We get periods of dramatic growth in equity, and we get periods of building drawdowns at particular points in time in relation to our floating equity. So in this instance here, we had a massive lift in our equity, and this is reflected down here with the drawdown disappearing to zero. But then as we start entering into these unfavourable periods where the equity is declining, our drawdown increases. And so you can map the relationships between the equity and the drawdown to see what are regarded as unfavourable periods. So in this instance, an unfavourable period would be represented by where that drawdown is high at around 22%, which correlates to this particular floating equity position at this point here. We use these linear markers here so we can see the relationship between the equity curve and the drawdown profile.
So that drawdown profile is drawn against the floating equity, not the realised equity.
Yes, mate. Yep. Which is important because we do treat a drawdown on our floating equity as a serious thing. Obviously, we want as much of our floating equity as we can. Therefore, we relate our drawdowns to our floating equity as opposed to our realised balance.
But that's something you wouldn't see on the MT4. I'm getting some echo here, Rich. I don't know whether that's coming through the recording, but the equity demonstration or the drawdown numbers that you get on MT4 is based on the realised position, not the floating position. Therefore, what we're seeing here is more realistic in terms of the performance of the portfolio.
Yes, I think so, mate. As we step through other markets that we have included, Bitcoin, of course, we've only got recent data in relation to Bitcoin that goes back to around 2014. So that's why this particular entrant into the portfolio occurs much later in the time series in 2014. But you can see this incredible lift in equity, which we demonstrated in the podcast last week. And it is a very volatile equity curve profile. If we go to coffee, once again, as I step through these, I don't need to explain them. It just shows you that each of these individual markets have unique equity curves and unique drawdown profiles. Here we go to Euro GBP, Euro JPY, Euro USD, Pound Yen, Pound USD. This is the Nikkei index, the NASDAQ, New Zealand USD. This is sugar, the Dow Jones Industrials Index, the S&P 500 index.
And while each of the individual instruments is showing fairly erratic and volatile movements, the master portfolio, on the other hand, is a lot cleaner and a lot smoother. That's because we've combined these individual portfolios to give us the master.
Yes. Here we are at gold. Here we are at Brent oil. Here's palladium, which has had a marvellous lift most recently. And here we have crude oil. So that's it for our overall portfolio of 22 instruments. Now what we need to do is look at the relationship between how they all compile together. Now, at the moment, we've got all 22 instruments turned on. And this is a portfolio result, which we've already seen, and its drawdown profile. Over here, you see the individual equity curves that make up that portfolio. But at the moment, because of this being Bitcoin, it totally dominates the series. So it's hard to see what's going on with all of the other 21 different markets. So I'm just going to turn off Bitcoin and eliminate that from the portfolio so you can see what I mean. So just by turning off Bitcoin, which has dominated the portfolio, we can now see the relationship between all of the different return streams of the different markets that comprise that portfolio. And with the 21 markets now being active, you can see that the nature of the overall portfolio profile has changed slightly, and the drawdown profile has also changed slightly. But before we start looking at the best combinations for this portfolio, I thought we'd firstly look at what we mean when we talk about correlation. So I'm just going to turn off all of the series except Euro USD and Pound USD.
And just to explain what you're doing there, Rich, your spreadsheet's organised in such a way that you can turn these individually on and off and still collate into an overall graph.
Yes, mate. Keep talking, Fred, as I'm doing this.
You need to speed up this process.
Yes, I know.
So interesting, you can see the sub-portfolio return stream slowly getting less and less, and the master portfolio modified accordingly.
There we go. So what we've done is we've turned off all the instruments or all the markets except two of them, which is the Euro USD and the Pound USD. And the reason we've done that is to discuss what we mean in terms of correlation. Now, everyone might be aware of the use of a correlation statistic, which looks at the way price moves of one return series in relation to the price movements of another return series. So when something is regarded as positively correlated, the two returns streams tend to move in tandem together. When they are negatively correlated and approach a correlation of -1, they are almost anti-symmetric in their price movements. So in other words, when one is going up, the other is going down. When one is going up, the other is going down. So we have positive correlation and negative correlation. And when there is no relationship between the price movement of one series and another, they are uncorrelated. So their correlation is 0. So in terms of the general correlation statistic itself, it ranges between +1, which is positively correlated, -1, which is negatively correlated, or 0, which is uncorrelated. But that's only using a single statistic, and we don't find that very useful because as trend followers, when conditions are favourable, we don't mind when our systems are all positively correlated. In fact, it's beneficial to us because when all are moving into profit together, that's a good thing for us trend followers. However, what we do worry about is during unfavourable conditions when we are reaching drawdown, we don't want to have positive correlation during those unfavourable periods. So to look at the relationship between correlation, we're using Euro USD and Pound USD. Now, correlation does not necessarily imply causation. That's a common statement you'll hear from statisticians. And what that means is there is no guarantee just because a return series is correlated to another return series that there's a causal relationship between that correlation. However, what you find when you're trading pairs of instruments such as Euro USD and GBP USD, there definitely is a causal relationship because the numerator of both those series is the USD. So if, for instance, the price or the return stream is dominated by price movements of USD as a single currency, you will find that there will be periods where Euro USD and GBP USD are very highly correlated. But there will be other times when, for instance, the pound works independently to the euro in terms of local economic factors, and then you might find that they become uncorrelated in nature. So there's no guarantee over the course of a time series that something will remain correlated. It can flip in and out of its degree of correlation with another return series by virtue of the causal relationships that might exist between the series. They might also flip in and out of a correlation relationship simply by random measures, as once again, correlation does not necessarily imply causation. However, we'll just step through where we find the pound USD, which is the grey line here, versus the Euro USD, which is the blue line here. You can see that there are particular periods, such as this period here, between here to here, where the Euro USD is anti-correlated with the pound USD. The pound USD is entering a drawdown and the Euro USD is favourably benefiting from those market conditions. This is an anti-correlated relationship here. However, there are certain times clearly when things become correlated, and over here is a good example. Between this zone here to this zone here, both are heading in the same direction, and they are strongly positively correlated. So when you include these two instruments in a portfolio, the relationship between these particular return streams create offsets with each other. And to explain that, you will note that in this period here of uncorrelated condition between pound USD and Euro USD, as the pound USD is going into drawdown, it's being offset by the favourable improvements of Euro USD during this period. So as a two-system portfolio, it is a better arrangement having this anti-correlated relationship here than both series going down together. What that will do would be to exacerbate this drawdown and make it higher. By Euro USD going up and pound USD going down, you'll see that they offset each other, which is beneficial to actually reducing the level of drawdown. However, during unfavourable periods such as this zone here down to this zone here, you'll note that both Euro USD and pound USD are heading both down in the same direction. They are positively correlated, but this is an adverse relationship for us trend followers, where the drawdowns will build and exacerbate. And you can see that with the increase in the drawdown to this point here, which is the drawdown at a maximum, because both series were encountering drawdowns at the same time and there were no offsets to this drawdown. So just by explaining the relationship between these two return streams, we can see then how one return stream provides offsets for another and vice versa, or if they are highly positively correlated at all points in time, they will not provide any offsets at all. So therefore, as a trend follower, we are after solutions that in totality offer an uncorrelated relationship with each other, because each of those return streams being uncorrelated will provide these degrees of offsets that will reduce our overall drawdown of our portfolio and improve what we call the risk-adjusted metrics, or the MAR ratio. So if we go up to this little section up here, we'll see that these two instruments have produced a compound annual growth rate of 3.8% or 9% over the entire time series, and a maximum drawdown of 42%. The risk-adjusted relationship is a MAR relationship of 0.09054. Now, what that means is you can see that the maximum drawdown of 42% occurred at about this time here. So this is where the maximum drawdown occurred. And you can see that's because both of these market return streams reached an adverse drawdown limit at this point here before they started going favourable at this going beyond this time frame here. So if we turn off, well, what happens if we turn off one of these, the pound USD, and just leave the euro USD? But remember, I'll keep a copy of the risk-adjusted return with 2. So this is a risk-adjusted return of 2. Now what I'm going to do is I'm going to turn off pound euro USD. We can see that the risk-adjusted return has actually decreased. It's gone from well, it's slightly increased by actually eliminating the pound USD return stream. There is no guarantee that a more diverse portfolio will offer a better risk-adjusted return, but you do find if they are uncorrelated in nature, more and more return streams improve the risk-adjusted return. So now that I've got most of that little theory underway, what I thought I'd do is I would turn back on all of these instruments now that we understand this, except Bitcoin, because that dominates the series, and we'll look at now compiling a portfolio that achieves the best risk-adjusted return. And at that point in time, our job is done with this particular Donchian series, in that we've gone through all of the design phases, and we are now at a point where we're happy with the overall portfolio result, and we are happy that the markets that comprise that portfolio are relatively uncorrelated in nature and produce the best overall risk-adjusted returns. You'll be aware of portfolio managers who tend to select their universes from different asset classes, and they might take 4 markets within the Forex asset class, 4 markets within the equities asset class, 4 markets within the commodities asset class. What they're actually achieving by a balanced representation across asset classes is what effectively we are achieving here with this visual mapping process. But we feel that the visual mapping process is a much more powerful and definitive way to achieve the best overall result and the best complementary mix of markets that make up the best portfolio with the highest risk-adjusted return. So at this point here, I've turned on 21 instruments, excluding Bitcoin. Now what I want to do is I want to eliminate the instruments that are contributing to this significant drawdown that we're experiencing. The highest drawdown in this period was achieved over here in 1999. At that point in time, our maximum drawdown was 40.972%. Now, there will be particular instruments that are contributing to that drawdown, and we can see it by following this line, this vertical line, and we can see that as we step through, we'll see that the pound USD is one of the instruments significantly contributing overall. Here it is. We can see that the pound USD is reaching its maximum drawdown at the same time that the portfolio is, and this is adversely affecting the portfolio returns. So let's look what happens to this overall risk-adjusted return metric when we turn off the pound USD. Now, I've just got to turn off pound USD. Here we go. So now we've got 20 instruments, and our risk-adjusted return, the MAR ratio, has now significantly increased from what was previously 0.2649 up to now 0.36187. You will see that the original drawdown of 40.97% has now significantly reduced to 29.6%. That's now eliminated one of the markets that was negatively contributing to the portfolio result. Now, as I'll pick another instrument which I found as Euro USD, which is also adversely affecting the peak drawdown. Now, what we'll find now is that the peak drawdown is at a slightly different location now, represented by this vertical line here. And we'll find that USD JPY is the major contributor to that particular drawdown. Here we go. Well, actually, USD JPY is contributing to drawdowns at other locations. But watch what happens when I turn off Euro USD JPY. Look at the MA relationship, and we'll turn it off. So we've lifted from 0.36187 now up to 0.38, an improved result where once again the relationship between the compound annual growth rate and the maximum drawdown is now more favourable to us. There are still a few more instruments I can turn off to achieve a better result. The pound yen is an example. I'll just turn that one off. I've turned that off, and we can now see that our MA ratio has significantly increased once again to 0.42. So down here, it's now gone from 0.38 up to 0.42. The relationship between the KGAR and the maximum drawdown is once again improving. And there is now one more instrument which is negatively contributing to this overall portfolio result, which is coffee. I'm going to turn that off. And here we go. The best result we can achieve through this visual mapping process is a MA ratio of 0.4496. This therefore means the portfolio overall has an overall drawdown result of 20%, approximately 22%, with a compound annual growth rate of 10%. You'll note as I put this horizontal line over the overall portfolio result that we now have fairly equal drawdown levels at multiple periods of time. That suggests to us that we can't really achieve any better improvements by turning off individual markets, because if we did, we'd find that once again our MA ratio will probably increase because one of these will spike up. When we get to a fairly level overall drawdown across the time series, we know that we have effectively risk adjusted the portfolio and achieved an optimal result. So in this particular case, we started with a total of 22 instruments. We turned off Bitcoin, we turned off pound USD, USD JPY, GBP JPY and coffee. So we've now reduced to a portfolio of 17 instruments. And we've now achieved a maximum drawdown over the long-term time series of 22% with a compound annual growth rate of 10% per annum. And we've achieved what we believe is a very powerful risk-adjusted portfolio. Fred, any comments, mate?
Not really. I think you've done a good job of explaining that. So for the listener or the watcher or the viewer, we hope that this explains how we put together a portfolio and what you can expect by initially creating a market or portfolio of various markets and then optimizing it back out again to deliver a portfolio with the returns you're looking for.
Excellent, mate. So just to explain what Fred and I have done now is we are now almost at the point of releasing these algorithms to our forum members. So next week, our podcast will be demonstrating how to load up these algorithms and how to apply them in either a backtest environment or a live testing environment for our members to use at their pleasure and get familiar with them. Anything you'd like to say there, Fred?
No, I think you've covered it all, Mitch.
All right. Well, I think that pretty well wraps this one up, mate. Have a great night.
Yeah, good day. Thanks for that. And hope Darren catches up with us next time.
All right, mate. See ya.
Bye.